tax hell is somewhere you don't want to be as an entrepreneur. On today's episode, I had Roger Herring, who is my personal accountant. Roger went over corporate structure, tax strategy, but most importantly, he gave powerful information on how to avoid paying taxes. Hope you guys get a lot of value and enjoy the episode. All right, we are back. Roger Herring, how are you, sir?
I'm awesome. How are you, Justin?
I'm doing good. I'm very excited to have this conversation with you. Before we get into stuff like corporate structure and the importance of having a good accountant,
Okay.
tell me a little bit about your background and how you became an accountant.
You know, Steve Harvey says jump. I got pushed.
You got pushed.
I was in corporate accounting. I was a corporate controller. We got bought. You know what happens when you get bought?
What's that?
Thank you for your service. Out the door you go. So here's 2 weeks severance and 6 months worth of insurance. So I own a shingle in self-defense. And man, that was over 21 years ago. We have just started our 22nd year in business. Back in high school, I got involved with junior achievement. And that's when I decided, wow, I love business. I love this. And got into the accounting program at the Citadel, excelled at it and loved it. Thought I was going to be a corporate accountant, and here I am in private practice.
Nice, man. So this is a real estate and business acquisitions podcast.
Okay.
There's going to be a ton of real estate people that are watching this right now. And when I first met you, right, you were probably the first accountant that I've ever met that actually niches in something. A lot of the accountants that I've met in the past, they deal with all types of different entrepreneurs, but you have a special niche for a reason, right?
Exactly. Real estate is literally 95% of our practice. The other 5% is high net worth and high income, and guess what? They have real estate too. But, most accountants start as generalists, and some people, they never change. We got to looking at our client base back around 1995 and saw, well, we got a bunch of realtors, we got a bunch of real estate investors, we got some home builders. Maybe we're attracting this specific sort that we've developed knowledge around. Let's expand on that. So we took trainings. We went back to school. We learned. We became investors ourselves. And surprise, here we are. It's now 2023, and real estate is definitely our niche. That's why I refer to myself as the investor's accountant.
Yeah, love it. I've seen the content. I know you got your own YouTube page. You're giving a lot of value out there. But for the individual that's just getting into entrepreneurship and they want to get into real estate investing, right?
Okay.
Talk to me about how important corporate structure is, because a lot of people, they think I just need to start a basic LLC and go to a site like LegalZoom, right?
Right.
And then they don't set it up right. They don't know the difference between an S corp, a sole proprietorship, a C corp, right?
Exactly.
Talk to me about the importance of how you set up your entity.
Okay. Entity selection is probably the number one most screwed up tax strategy there is. Because when you form that entity and you decide how you're going to be taxed, well, that decides which part of the tax code you're coming under. That's going to decide how you have to operate your business. Now, let's say that you're going to be a flipper. Do you know that's ordinary income that you're about to be dealing with? Do you know that ordinary income has self-employment tax? Do you know that you have to avoid it? Most people don't have a clue. They've never heard of self-employment tax because they're coming out of corporate America. And there are strategies to avoid it. Now, most people think, okay, I'll set up an LLC and I'm good. Well, legally you're protected, but when you set up an entity, you're actually setting up two entities at once. One is your legal entity where you get your protection from. The other, though, is your tax entity. And that can actually be the more important of the two, because that's going to decide how much of your money you get to keep. Yeah.
Wow. So if I want to come into the real estate game, and let's say I want to start out as a wholesaler, right?
Okay.
And then I want to get into fix and flips, and then I want to start having rentals, right?
Okay.
Should I just create a business trust with, multiple LLCs? What's the best way to go about that?
Okay. In the beginning, you don't want to overtake the plumbing.
Okay.
And there's absolutely nothing wrong with having the business trust out there as long as the business trust is what we call a disregarded entity, because you want everything ultimately flowing back to you at this point of the game. Now, understand what your income is. If you are going to be a wholesaler, that's ordinary income. If you're going to be a flipper, that's also ordinary income. Now, if you want to get into rentals and buy and hold, all of a sudden that's passive income, and that's totally different.
Right.
So someone fresh out of the gate that wants to be a wholesaler, in general, they're going to want an LLC, and they're going to want to be taxed as an S corporation.
Okay.
Because the S corporation, we can become our own employee, and we pay ourselves a salary, and we only pay payroll tax on the salary. Without the S election, we're going to have to pay payroll tax, or what is then termed self-employment tax, on everything we make. Here's an example. What if you made $100,000 net wholesaling? If you are not an S corp and you are at just a plain LLC, you will pay the income tax on the $100,000, and you will pay $15,300 in self-employment tax. Now, you have an S election, you make the same $100,000. You're still going to pay income tax on the $100,000. But now you're paying the 15.3%, the payroll tax / self-employment tax, only on your salary. So if you pay yourself $50,000, you've just cut it in half. Now, $50,000 is probably too much to pay yourself at $100,000. You could pay yourself more like 30. But that is a huge savings in taxes immediately. And guess what? That's one election, and you can have that savings every single year now. That's one of the ways you keep your money, and the most basic.
So when you say someone is just like a regular LLC, is that more considered of like just being a sole proprietor?
It is the sole proprietor.
Okay.
Because you see, if you look at the tax code, there is no tax form for an LLC. An LLC is going to be taxed as whatever we say it's going to be taxed as. It totally depends on what papers you file or fail to file.
Gotcha.
If you file an LLC, a single member LLC defaults to being a sole proprietorship for tax purposes, unless you file either an S election or a C Corp election.
So what is a C Corp? Like, what would make someone choose to be a C Corp?
C Corps are usually for larger ventures where you're going to have multiple owners involved in it, or C Corps can be used as a tax shelter in very specific circumstances. It is rare that I recommend to someone that they start out operating as a C corporation.
Gotcha.
There are some times that we'll use a C Corp, such as, did you know that if you had a C Corp, say in Nevada, you could file a lien against your personal residence and cloud the title for some asset protection? It's perfectly legal. And all they would see is if an attorney came in and started looking, oh, well, his house is fully liened, I don't need to look anymore. Now, if he dug a little deeper, he'd find that the lien didn't really have any substance behind it, and he could take you to court. But the whole idea is to create a smokescreen. That's one use. We've got some strategies that we use around rental properties with a C corporation that allows us to take long-term rental treatment for the rental properties and let the C Corp function as a hotel. But generally, I don't recommend that people operate in the C Corp, especially out of the gate, unless we're talking multiple people and a specific plan.
Is corporate structure, would you say that's the biggest mistake people make when they're setting up their LLC?
Oh, yeah. Because you know what happens? I have people that create an S Corp and start buying rental properties. You don't ever hold rental properties in an S Corp. It can be a bloody nightmare.
Talk to me about that. Why is that not a good idea?
Okay. The S Corporation is not you. It's a clone of you. Let's put it that way. But it's a separate entity, but it passes through to your return. See, now, when you put the rental properties in there, you don't own the rental properties. The S Corp does. And properties that are actively managed by an S Corporation are not passive. They're ordinary income. So they can require a salary to be paid on any income that's there. There's also restrictions on transferability. Let's say that you want to pull that property out now and put it under another entity. You can't do it because of what's called the related party transaction rules. If you do it, you have to essentially sell it to yourself at fair market value and pay tax on the gain.
Oh, wow.
Ouch.
Yeah.
You can't just do a cash out refi and take the money out.
Wow.
Yeah, you have to follow the rules for the S Corp. And the worst of all, okay, let's say that you're holding all of your rentals inside of that S Corp. We want to use leverage as landlords. We want to use other people's money. Well, the law says that we can only deduct a loss from the S Corp if we have personally funded that loss. And we personally funds means all that money that we borrowed, it has to be our money, not somebody else's money. So you might be in a situation like some people found themselves in, and now they have no basis, meaning no skin in the game, no money left in that S Corp that belongs to them. Now they can't take the deductions.
Wow.
Yeah, painful.
It goes deep just from not setting up right. That's
All
crazy.
from not setting up right. I've had people come to me that have 100 properties in an S corporation. Yeah. And I have to tell them, well, you better keep flipping some properties, otherwise you're not going to have any basis to be able to deduct.
Yeah. So when you say ordinary income, you're talking about the active income.
I'm talking active income.
Okay. So what is the difference? Because I know there's a lot of people that are watching this or fresh to this or just getting into this. Explain the difference between active income and passive income.
Okay, let me just lay it on the line. There's really no such thing in the real world as passive income. You're going to work your butt off for it, no matter what. When we talk about ordinary income versus passive income, this is how the IRS defines stuff. Okay, ordinary income is where I am operating in a business. You know, let's go back to Robert Kiyosaki 101. This is a great way of defining it. You know, a lot of us got into the real estate game and the business game because of Rich Dad, Poor Dad.
Yep.
Let's just admit it. Yep. So he says 3 types of income. There's ordinary income or your active income. That comes from your W-2 job. That comes from operating a business. That's your W-2 from the business and the K-1 coming from the business, but you're working for that money every day. Then there's portfolio income. That's your interest income and your capital gain income and your dividend income. It's coming in for where your portfolio of stocks, your portfolio of properties. Then there's passive income. Passive income comes from essentially 2 places. It comes from rental real estate, and it comes from being a limited partner in a partnership. For the folks that have been around real estate a while, being in a syndication, limited partnership, that's a passive income stream.
Okay.
Owning rental properties, whether they are residential, single family, multifamily, or if they're commercial, that's all considered passive income. And it's all taxed differently. What's the biggest difference? Ordinary income, Social Security, Medicare. It's the most taxed income.
There's no way to avoid that either.
Only if you have the right tax strategy and the right business structure so you can minimize your salary. Okay? Passive income, least taxed income.
So now, if I have rentals, because I've heard you talk about this on your YouTube, and a lot of people wonder how the wealthy are not paying taxes, right? You know, a lot of people in middle class, they look at these people like the heavy hitters that are in real estate, and like they're con artists or they're criminals because they're not paying taxes, right? Talk to me. How are people not paying taxes?
Okay. I'll tell you, I've got some clients that literally have not paid tax for 15 years legally. How is it done? Most of the time, it's done through rental real estate. Now, I tell people, you know, you don't want to pay tax, don't make any money. But with rental real estate, there actually is a way to make money without making money. It's called cash flow. Rental real estate creates positive cash flow, not profit. And positive cash flow is not taxed, but it goes straight into your pocket. Now, profit is taxed, but the whole idea is to eliminate the profit, create a loss, and if we can, carry it over to our ordinary income. So here's how this works. The IRS says there's 3 types of investor. There's the passive guy. What he does is he writes a check, he buys a house. He's never seen the house. All he wants is an income stream. He gets a check every month. The IRS says all he can do is apply any losses he has against his income. Okay? Then there's this active guy. And the active guy swings a hammer. He manages his property. He makes the decisions. He doesn't rubber stamp a property manager. And because he works on his property, the IRS is going to allow him to take up to $25,000 worth of loss against his other income. Now, some people at this point will ask me, well, I don't want to lose money. You're not really losing money. This is what we call a phantom loss.
Phantom loss.
Phantom loss means it's a loss on paper only, and it's created with the keen of all deductions, and that's depreciation. That's where we're recovering the basis of the house over a number of years. And there are tactics that we can use to accelerate that depreciation. In fact, between 2018 and 2022, we could do a technique called a cost segregation that breaks out the components of the house, like the countertops, the doors, the windows, etc., and we could write them off immediately using bonus depreciation. That's a whole other topic.
Yeah.
So what we do here, this guy's got $25,000 that he can apply against his W-2 income or his business income and reduce his overall load. Now that's until he hits $100,000 of adjusted gross income between himself and his spouse. Then he goes into phase out. For every buck over 100 grand he makes, he loses 50 cents of that maximum deduction. So if he's got $150,000 worth of ordinary income, he can't take any money. All that loss is going to carry forward to where he can use it in the future. Excuse me, my throat is getting dry.
No, you're good. You're good. You're giving a lot of value right now.
Then there's this thing, I call it the goose that laid the golden egg. And it's one of 2 goals that anybody in real estate should aspire for.
Okay.
This is to become a real estate professional.
Okay.
Now, this has absolutely nothing to do with having a license. And it's not about money. It's every bit about time. The way this works is there are 3 things you have to do to be a real estate pro. The first is you have to spend more than half of your for-profit time in real estate. So someone like me, I'm a tax strategist. This is what I do all day, every day, and it's not an 8-hour job. It's more like a 10 or a 12-hour job when you own the business. I can't be a pro because I don't spend more than half my time in real estate. Okay? So, more than half of your for-profit time spent in real estate, and you have to be an owner. You can't be a W-2 working for somebody else. You have to own the company.
Gotcha.
Okay? Now, rule 2. Minimum of 750 hours. Well, people then want to know, well, Roger, what are those professions that you're talking about being in real estate? You can be a broker, a real agent, a landlord, a property manager, a flipper, a wholesaler, a residential builder, and in some cases, a commercial builder. Any of those professions, you're good if you're an owner. Now, there's a third requirement. Across all of your rental properties, you have to prove material participation. And material participation, there's about 7 different ways to prove it. The way most people do is they make a little election on their tax return that combines all of their rental activities into a single business. And as long as they have 500 hours across all of those rentals, then they have material participation. And oh, by the way, that 500 can be part of the 750. That's pretty cool. The 750, one spouse has to qualify outright to be the pro. But for material participation, you can combine a husband and wife's hours together. So let's say the husband's out here and all he did is flip properties. That's where all of his time is. But the wife, because they're married, husband qualifies real estate pro. If wife has 500 hours on rental properties, they got it.
Wow.
They're good.
Wow. So we've talked pretty in depth about corporate structure and the importance of it.
Can I stop you?
Go ahead.
I didn't finish real estate pro because this is the most important thing. Okay, what does real estate pros get? No limits.
What do you mean by no limits?
There's no income limit. That $100,000 income cap just went away. There's no phase out. And oh, by the way, that $25,000 of maximum write-off just went to infinity. I've got a client, his wife works downtown. She's making about 3 bills a year. She's in marketing. He manages their properties. Those properties cash flow around $200,000 a year. That money goes straight in their pocket. They also produce anywhere from $20,000 to $140,000 of passive losses each year. All phantom, all from depreciation tactics. And because he qualifies real estate pro, he can apply that against her other income. That's how the wealthy pay no tax or pay very little tax. They understand how to properly, legally manipulate the code.
Man, that's powerful right there.
Yeah.
When you say depreciation tactics, are you talking things like cost segregation?
Cost seg is one. Bonus depreciation is one. There's a little trick. It's called de minimis.
Okay.
You know, a lot of times you'll have repairs and things that are $2,500 or less. Well, what most people don't know is back in 2014, the IRS published a regulation on repairs and maintenance. And anything over $200 that had a life of more than 1 year, by law, has to be depreciated. Surprise, most people don't know that. But there's also the ability to claim the de minimis election. And de minimis says anything under $2,500, single unit of property, that means labor and materials and supplies. If it's under $2,500, I can write it off immediately as repair and maintenance.
Wow.
Now, that means I get to take it right now, and it means when I sell the property, I don't have to recapture it. Now, you know, if you're borrowing money, we better watch out because the underwriters don't like that.
Right.
Underwriters want you to have money. I don't want you to make money. At least I don't want you to make money on paper.
Right. I get it. So what is bonus depreciation?
Bonus depreciation has been around since about 2008. It went to 100% in 2018. This year for 2023, it dropped back to 80. Next year, it'll go to 60, then the next year 40 until it finally phases out. But what bonus depreciation is it allows us to write off the purchase of any piece of equipment or property that has a useful life of 20 years or less. So let's say I go out and I buy a mega computer for $4,000. Bonus depreciation lets me write it off right now. Now, this is only for federal tax purposes.
Okay.
Most states don't allow bonus depreciation.
Why are they phasing it out?
Honestly, I hate to get into politics, but the way they made it 100% required them to phase it out. They used a process called budget reconciliation, which means you can't affect the deficit by no more than a certain amount of money. And the way they did it is they put the bonus from 2018 through 2022, and then they had to sunset it come 2026 in order to be in compliance with law.
Gotcha. Okay. So with cost segregation, right, that's something that I know about, and it's a super powerful way to avoid paying taxes. What are the pros and cons of cost segregation?
Okay. The biggest pro is you get a great big write-off right now because cost segregation, what it does is it breaks the components of a building out from the building itself. A residential rental property normally has to be depreciated over 27 and a half years. If it's a commercial property, say a storage unit facility, that's a 39-year depreciation recovery.
Wow.
Now, by pulling the components out, it lets us accelerate depreciation into 3, 5, 7, and 15-year buckets. But because of bonus depreciation being at 100% since 2018, what we've been doing is we're doing cost segregations, and then anything that we pull out is also subject to 100% bonus depreciation. So someone buying a $400,000 rental property could very easily get $120,000 worth of cost segregation, meaning an immediate write-off of $120,000. Now, that's the molasses. There's obviously sulfur with this. Okay. Once again, bonus depreciation is not recognized by the state. Okay. So you can still do a cost seg, but you're going to have to use the 3, 5, 7, and 15-year brackets for state depreciation. Okay. That's one. Number two, if you sell the property, you're up a creek. Because here's what happens. Look at this as an interest-free loan from Uncle Sam. If you cost seg this year and sell next year, they're going to recapture all of that depreciation as ordinary income. Yeah, that's not good, because what happens is when you do the cost segregation, it changes the code section of the depreciation. So if you sell it, they're going to recapture. Well, Roger, you said if you're not going to keep it for a certain amount of time. That time horizon is usually 7 years. Because if you use the time value of money equation, then 7 years or more, you're on the correct side of the time value of money and you win if you think of this as an interest-free loan. Yeah. Less than 7 years, less than 5, you're going to lose. Between 5 to 7, it's really a toss-up. It's all goes down to the numbers. So that's the second drawback. Here's the third drawback. A lot of people in investing want to do a 1031 exchange where they kind of trade up their properties. The whole idea is to roll the gain forward and to continue depreciating the property. Well, if you've done a cost seg, you can 1031 everything that you didn't cost seg. The cost seg is going to get recaptured immediately. Now, I need to put a general warning out here. There are some non-reputable folks really pushing cost segs on everybody. Yeah. Cost seg is not suitable for everyone. First, you better make sure you can take it. That means you're going to be either a real estate professional or the building is owned as an ordinary income item, like you bought a building for use in your company and not as a rental. Yeah. Something like that. Or you better make sure that you're not passively trapped and that you can get the full $25,000 benefit from a cost seg. Okay?
So the only reason someone would need to really, I guess, use cost seg or 1031 or try to avoid paying the taxes is if you have a lot of ordinary income.
It's to solve income problems. That's it. Most of my clients that are doing cost segregations, what they're doing is they are real estate professionals. They are creating large losses in their rental portfolio because they don't plan on getting rid of the property. And then what they're doing is they're applying that loss over against their ordinary income. Yeah. Now, can I tell you about a loophole?
Yes, please.
There may be people that are not real estate professionals that need to hear this. There is a way in the first year, if you buy a short-term rental, that you could write everything off from the short-term rental, doing a cost seg, and apply it against your ordinary income, even if you're not a real estate pro.
Talk to me.
Here's the loophole. First, that property has to have an average stay of less than 7 days. And the way you calculate that is number of days rented divided by number of renters. 7 or less, you've passed test 1. Test 2, you can't provide any substantial services. Now, a welcoming bottle of wine is okay. What I'm talking about is concierge type service, tours, maid service while they are there. You can clean up certainly after, but nothing during, okay? Because you don't want to qualify as a hotel.
Gotcha.
You pass that, that's the second hurdle. Here's the third. You have to have material participation. And one of the best, easiest ways to do that is to buy a property closer to the end of the year. And you literally go in there and decorate it, and you spend 100 hours, and you make sure that nobody else has more time than you. That's material participation. You check those 3 boxes, and now any loss on that property this year is 100% deductible against your ordinary income because of a loophole of an old law that's still on the books.
Wow.
Yeah. I actually learned that in a class that I took from one of the big strategic gurus last week. Pretty awesome.
Yeah, it's
now,
some deep stuff.
Here's the warning, though. Because this is outside the norm, and you're going to have to literally in your tax software override some things to make this happen. Because if the IRS sees a great big deduction, they expect to see a real estate pro election. Well, a doctor or an attorney can't make that. So be prepared to defend at audit, dot your I's and cross your T's. But you can, if you're prepared to do the work, you can save a pile of money and you don't have to be a pro.
Are you familiar with investing into whole life insurance policies to help with tax strategy?
There are tax strategies that are out there. I have a group that I work with that does that. It's for a more advanced, wealthier, because what you're talking about a lot of times is a whole life policy, and we move into what's called infinity banking, where you are accelerating the whole life policy, but it's really becoming your lender. It's not giving you any type of tax advantage at that point.
Gotcha.
The whole idea of infinity banking is you create a whole life insurance policy, and you're going to use something called premium financing. Okay, and the premium financing is going to accelerate the cash value of the policy, and then you are making a loan from against the cash value. You're not borrowing your own cash value. The loan comes from the insurance company. So the beauty of infinity banking is the money in your cash account is still growing. You have a loan from the insurance company backed by your cash value.
Gotcha.
So you're not having to go through the bank, and you're guaranteed to get the loan because the cash is backing it up.
Gotcha.
That's the whole idea. Now, in most cases, you have to be an accredited investor to do this, which is the other goal that I want my folks in real estate to get. Now, to be an accredited investor, you have to have $1 million net worth, or if you are a single person, a $200,000 adjusted gross income for the previous 2 years with the expectation that it will continue. Or if you are married, that has to be $300,000.
What's the benefits of being an accredited investor, and who is best suitable for that?
Well, you know, being an accredited investor, it allows you to get into different tax structures and to different income structures that most people cannot. Real estate funds and real estate syndications are two of the biggest things that comes to mind right now. Basically, I've got clients that do this. What they do is they go out and they're taking down a 500-unit apartment building. Their whole idea is to improve the building, raise the rents, and in 5 to 7 years sell it. Now, that's real money. But because it's a risk, what they're doing is they're funding it by creating a syndication. So what they do is they take money from accredited investors into a separate LLC as limited partners on that. That LLC owns the property. This creates passive income or passive losses for the investor. Okay? And the returns on it are much higher. You're dealing with people that know what they're doing, so there's actually less risk, but because of the amounts of money involved, you have to be accredited to get involved. Now, funds essentially work the same way, but the difference is with a fund, you're trusting the fund manager to pick the real estate. With a syndication, it's one specific piece of property, so you get to pick the real estate. Okay? Say, I like this property, I'm going to do it. I don't like this property, I'll pass. You don't have that option in a fund. The other thing, and we're in Georgia. Let's talk about Georgia for a minute. Movies. We make movies in Georgia. State of Georgia, what they do is they offer film tax credits to the people that come in and make money. And the way they fund their picture is by selling those film tax credits for like 90 cents on the dollar. Now, an accredited investor can go in and buy those film tax credits, usually in lots of 50,000, and they can pay their state income taxes with it.
Wow.
Yeah, it's pretty cool. It's pretty cool. So they're saving about 10% on their state income tax.
So if I want to set up a syndication, do I personally have to be an accredited investor?
You should be.
Okay.
You should be. Technically, no, because you're not participating on the syndication side. See, there's actually two LLCs that's involved, but if you're not the accredited investor, you need to bring in a partner that is.
Gotcha. What about a fund? Because I've heard like funds are more like freely to where there's not a lot of regulations and requirements.
Well, it depends on if it's a Reg D fund or if it's an open fund. Cardone does have some funds out there that you do not have to be accredited. So there are funds both ways. One way around it is a loan fund. Okay, instead of equity, you're making a loan. Yeah. So for those type of things, you don't have to be accredited.
Got you. So just to be clear, like if I set up a syndication, syndications are more designed to go after a specific asset.
Correct.
Where a fund, they can go after different asset classes.
That's correct. It
doesn't have to be multifamily. It could be single family, storage facilities.
Could be any of the above. It could be a targeted fund that, like some folks that I know that only go after storage facilities. It could be one that only goes after large multi-tenant. It just depends.
Got you. So, I've been thinking a lot about that lately. Because there's a guy out there that's teaching about setting up funds. Mm-hmm. And I feel like I'm at the point now so where I've been in this for over 5 years and I'm ready to start scaling at mass and just create more of that cash flow. Mm-hmm. But with that, there comes a lot of responsibility because you're managing people's money in regards to opening a fund. So it's like, my question is like what type of individual do you feel is best suitable to create a fund?
Okay, I'm going to use one of my clients as an example. This is a young man. Well, everybody's a young man to me. I'm in my mid-50s. So this gentleman's in his early 40s. He has been my client for about 12 years now. So I knew him when he was first doing his first flips. He has grown to the point that he is much more than accredited. Has a very high net worth, does podcasts, and is very well known on Bigger Pockets. Okay. I'll stop at that.
I think I know who you're talking about.
But you got to have, number one, the experience to back it up. Mm-hmm. I see people that tell me they're going to start a fund and they've got 2 flips under the belt and they own 1 rental property. And it's like, oh, really? Yeah. What are you going to do? No, I want someone with experience, somebody that has the capital to back it up, and someone that I know is going to put the effort into it. Mm. In his case, I know personally all the partners that are involved.
Mm. Yeah. Okay.
So I want to know where my money's going and how it's going to work.
So it needs to be a reputable individual that has a track record.
You better believe it.
Yeah.
You better believe it. That the track record, the net worth, the accreditation status, all of that has to be there.
Gotcha. It makes full sense. The last thing you want to do is invest your money into something that you don't trust the individual that's running it.
Mm-hmm. So. It's like I tell people in seminar, in God we trust, all others pay cash. We verify.
Yeah, definitely. So let's get into revocable trust.
Okay.
What is a revocable trust and what are the benefits of it?
Okay. In my opinion, everyone should have a revocable living trust. Okay. You know what the primary reason? It's not asset protection. It's to avoid probate. Man, probate sucks. I'm dealing with it right now. I lost my mom back in November. Probate is awful. But if mom had listened to me and had created the revocable living trust and had the title to all of her assets in that trust, I wouldn't have had to deal with this. Because what happens is when you pass, the revocable living trust becomes irrevocable. And now all the assets that are in the trust pass according to the trust regs and the will. So I wouldn't have another probate attorney involved. I wouldn't be dealing with the state of North Carolina.
Wow.
That's the first thing.
Yeah.
Okay. It's for organization. In fact, it's really the basis of what is called a trifecta. And that's just a diagram. I'm a student of Mark Kohler, who is one of the top tax strategists and tax attorneys in the country. And he uses the trifecta to explain the way things work. Your active income is on the left side of the trifecta. Your holds on the right side of the trifecta, and the base is that revocable living trust. Everyone should have them. Well, I got asked a question the other day. Well, what about a spendthrift trust? Well, first off, spendthrift trusts are irrevocable. And the biggest difference between a revocable and an irrevocable, let's say you have a house and you put that rental house into an irrevocable trust. If you're killed in a car accident, the people that inherit that, they just keep operating. If it's in a revocable trust, use my mom as an example. She bought a house back in 1977 for $55,000. The day she passed, if that was in a revocable trust or not in a trust at all, I get a stepped up basis to the current fair market value of the house. Yeah. That means I can sell the house. There's no capital gain. If it's a rental property or was a rental property, all the depreciation goes away. I can keep renting it and start depreciation over. Jeez. If the property had been 1031'd, all the stacked up gains from the 1031 go away.
Jeez.
Step up to current basis, and I start depreciating all over again. That's called the death strategy. And now that happens if it's in a revocable living trust or just owned in the name. You just have to deal with probate then. But if it's in a irrevocable trust, like a spendthrift trust, you don't get any step up in basis whatsoever. Everything continues as it is. The other thing to remember about an irrevocable trust, they are just that. They are irrevocable. You can't undo it once you have done it.
Gotcha.
Oh, and did I tell you that the top tax rate of 37.5% starts at $12,000 in an irrevocable trust? Yeah. For an individual, that's more like $300 and something thousand. Married filing jointly, it starts, I believe, somewhere in the sixes now. Yeah, $12,000, you're at 37.5% in an irrevocable. Now, if you put it into an irrevocable trust, is it asset protected? You better believe it. But you also better consider everything that you're giving up, and is that the right way to protect your assets?
Jeez.
Yeah. Oh, and when you put the things into the trust, they're gift tax issues.
Do a lot of people make the mistake by setting up the wrong type? Because I know there's irrevocable and there's revocable. Mm-hmm. I've heard of nightmares of people setting up the wrong one.
Yeah, it is a nightmare if you intended to set up a revocable trust and you set up an irrevocable. That's just it. It's irrevocable. You can't do anything about it. And now you've got gift tax issues for anything that you put into the trust because that's considered a gift, and you can't take it back out. Who's in control of the trust? Now, there are legitimate reasons. Let's say that you've got a child that's special needs, or you've got a grown child that can't handle money and you want to provide for them. Well, that's where an irrevocable would come in. There's a place for it.
Yeah.
But generally, I don't recommend it. You know what? You need to go find a good, solid asset protection attorney that knows all the inside and outs for the state that you're in. Because most of these people that come out here and peddle spendthrift trusts or these asset protection trusts or whatever, they're based on a compendium of laws of multiple states, and they want to charge you $25,000 and they tell you you'll never have to pay income tax again. Yeah, you might not, but the trust will.
Wow. So what about a business trust? Why do people set those up?
The business trusts have some asset protection, and they are utilized in conjunction with LLCs. Now, there are different laws in different states, okay? And the thing you have to be careful of, once again, revocable or irrevocable. Now, they'll give you some protection, but at the end of the day, most of the assets are owned by that trust.
So should you have both a business trust and a revocable, or just one?
It depends on what you're trying to do. It depends on your situation. The business trust may come in later, down the road. Revocable trust, I think everybody should have one, just to get out of dealing with probate.
So I remember I went to your seminar, and there was a lady that was talking about business trust, but it was more along the lines of protection, being hidden, to avoid lawsuits and people just coming after you because they know of all the assets you have. Does a revocable do the same thing?
Revocable is not a smokescreen. It is not an asset protection entity. It is an organization entity.
Gotcha.
So, all those advanced stuff, I refer that to the legals.
Gotcha. Okay, so get with like a tax attorney, someone that specializes in that.
Not necessarily a tax attorney, because a tax attorney, what do? They deal with complex income tax issues.
Okay.
You better deal with an attorney that specializes in asset protection, estate planning,
Gotcha.
that type of thing. You know what? The right tool for the right job.
Right, exactly. I know we're running out on time here, but real quickly, what's a Roth 401k? And
Roth
what is the benefit of that?
Dude, a new law was passed not long ago that says the employer contribution against your 401k can now go to Roth. Now, Roth, you can have a Roth IRA, you can have a Roth 401k. The Roth IRA, you can only put $6,500 in. Roth 401k, anybody could put up to the max in, and this year that's $22,000, or if you're my age, that's $30,000.
Wow.
Now, you can have your employer contribution now go to the Roth. Why do we want Roth? You pay tax on it now. Forget the tax deduction. Who cares about that? We're in the second lowest tax rates of our lifetime. Take the Roth because it's going to grow tax-free, and you can take it out tax-free on the other end. So anyone under 55 had better be going Roth. Between 55 and 60, think about it. 60 over, depends on how long your family lives. But, it blows my mind that a lot of people, especially self-employed, don't take advantage of the Roth Solo 401k. You can put up to $70,000 in one of those if you're my age.
What if you're in your 30s?
If you're in your 30s, I believe it's 62.
Still a lot
thousand,
of
a lot of money. That's going to grow tax-free. You can take it out tax-free. And did I mention it can be self-directed?
Wow.
Yeah. It is one of the greatest wealth building tools there is, and I am shocked at how few people actually take advantage of it.
Yeah, I think just it's not talked about enough, right? Because there's a lot of things you've said throughout this entire episode that's like, even though I've been in the game, it's almost like a refresher course.
Yeah.
Because in the financial literacy aspect, for the people that are out there teaching financial literacy, there's not too many people out there that are talking about the things you talked about. Like, I've heard of Roth 401ks probably for the last 3 years, but I've never sat and took the time to learn about the benefits and what it does.
Oh, yeah.
It's not talked about.
It's a heck of a wealth building tool because, you go to talk to a tax man, he's going to tell you how to reduce your tax. We're about a lot more than that. We don't want to just reduce your tax today. We want to increase your long-term wealth. We want to show you taxes, not necessarily to avoid taxes today. Let's avoid them 5, 10, 15 years into the future.
Yeah, that's powerful. So with a Roth 401k, can I, if I want to be a private money lender, right? I want to do transactional funding or whatever the case may be. Can I use that to be a private money lender?
Sure can.
Wow.
It's a loan. That's one of the allowed transactions.
And I get to avoid paying taxes as I receive that money back.
And I can tell you another secret too. You could get away with doing 2 flips in it.
Wow.
Now, why a 401k? Because a 401k, let's say you wanted to buy a rental property.
Right.
Guess what? A 401k doesn't have what we call unrelated debt financed income. You see, if an IRA borrows money, to the extent they borrowed money, their deal is taxable at trust rates. That just does not happen in a 401k. So you could put $100,000 down, borrow $300,000, and acquire a rental property.
Wow.
Oh yeah, it's a nice trick.
Roger, we're definitely going to have a part 2 because I got so many other things to talk about. But I know we're limited in how long we can be in this room.
Right.
But thank you for taking the time to give all the value you gave on this episode. Guys, I hope you guys are listening and paying attention. I'm going to put a link below if you guys want to have a consultation with Roger. Your services are nationwide?
Nationwide. I don't particularly like New York, but I will deal with New York on a limited basis. Most of my clients are in the Southeast, but I've got clients in about 14 different states and even overseas that own property here.
Got you. Guys, he is the investor's accountant. If you want to get on with an accountant that is not just an accountant, but a tax strategist and someone who specializes in real estate, I highly recommend this guy. He is my accountant. He is super sharp, super knowledgeable. Roger, thank you for coming on the show. How can they get a hold of you?
All right. The best way to get a hold of me is to go to my website, theinvestorsaccountant.com. You can click that link that you just mentioned down below.
Yes.
Most of the time you will get a reply from my executive assistant. But I hope to talk to all of you. And here's a special thing that I'm going to do just for listeners of this podcast.
Here we go.
Normally, I charge a $100 reservation fee to make sure that people show up. If you schedule a consultation, 30-minute consult from the link that's right here, I won't charge you that $100.
That's super valuable, guys. All right. So listen. Please like, share, subscribe, comment your favorite part about this episode. You guys got so much value out of this. I will see you guys on the next episode.